Welcome to the Deep Dive. Today we are taking a look at one of the most powerful but also really finicky financial incentives in the entire U.S. tax code.
Right.
We're talking about qualified small business stock. You'll hear it called QSBS.
Yeah.
It's under Internal Revenue Code Section 1202. And the goal here is potentially zero, and I mean zero, federal tax on massive capital gains. And we're going to navigate some huge changes from the One Big Beautiful Bill Act, the OBBA.
Yeah, and this isn't just, a technical thing for accountants. It's really a foundational piece of early stage investment strategy.
For who specifically?
I mean, if you're a founder, an early employee, an investor, doesn't matter if you're PE or VC, you have to see QSBS not just as a tax break. It's a critical factor in deal valuation.
So the savings are big.
Oh, they're huge. But the hidden cost is this massive, and I think often underestimated compliance burden you need to prove eligibility, basically from day one.
Okay, let's unpack that. At its core, what is QSBS? It's a government incentive, right? Designed to push capital towards smaller, growing C corporations in the U.S.
That's it.
And the main benefit is pretty simple. A non-corporate taxpayer, so an individual, a trust, a partnership, can exclude capital gains from selling stock in a qualifying company.
And that exclusion, it can be up to 100% of the gain.
100%.
100%. As long as the stock was acquired after September 27, 2010, and you've held it long enough.
And there's a cap, right? It's not unlimited.
No, definitely not. It's capped at the greater of $10 million or 10 times the taxpayer's adjusted basis in the stock.
And that 10 times basis rule, that's where investors who put in, say, $5 million could potentially exclude up to $50 million in gain.
That's the mechanism. It's incredibly powerful.
So here's where things get really timely, because this new legislation, the OBBA, is just completely reshaping the whole playing field. This is for stock acquired after July 4th, 2025. What are the big headline changes?
Okay, so they basically just expanded everything. First, the flat cap. It goes from $10 million up to $15 million.
15, wow.
And it will now be indexed for inflation starting in 2027.
Okay, what's second?
Second, the size of the company that can qualify is getting bigger. The gross asset limit immediately after the stock is issued goes from 50 million up to 75 million, also indexed.
So that right there, that just expands the universe of companies that can qualify.
Right.
You could have later stage Series A, maybe even some Series B companies that would have been shut out before by that $50 million wall.
Exactly. And the third change is maybe the most strategic one. The required holding period is getting shorter.
From 5 years down to
just 3 years.
That's huge. A shorter timeline is, well, it changes everything. But there's a catch, isn't there?
Yeah.
Not the full exclusion after just 3 years.
Correct. The OBBA brought in this sort of a phased approach for new stock. You still need the full 5 years to get the 100% exclusion.
Okay.
But now, after 3 years, you qualify for a 50% exclusion.
50, okay.
After 4 years, it's 75%. And only when you hit that 5-year mark do you get the full 100%.
What's so interesting about that is how it changes investment velocity. I mean, before, if you were a PE fund looking at a 4-year hold and exit, you couldn't even touch the QSBS benefits.
Right. It was off the table.
But now, getting 75% exclusion after 4 years, even if it's not the full 100, that makes the math totally different for investors with shorter time horizons.
That is the key implication. It unlocks the benefit for private equity sponsors, for growth equity funds, people who are structurally, allergic to a 5-year lockup.
It gives them a real high-value tax outcome much earlier.
Which could completely change how they structure early exits. It just accelerates the timeline.
To really appreciate this, let's look at the history of Section 1202. It was enacted way back in 1993, but for years it was. Well, it was almost irrelevant. Why was that?
It was pretty much dormant. Back in 93, the exclusion was only 50%. And more importantly, the top capital gains rate was 28%.
So when Congress lowered capital gains rates in the early 2000s,
the benefit of QSBS just shrank to almost nothing. Sometimes it was just a 1% tax saving on the gain. Nobody was motivated by that.
So it really only became a game changer after 2010.
Absolutely. When the exclusion was permanently hyped to 100% for stock acquired after September 27, 2010, it became incredibly valuable. And then the 2017 Tax Cuts and Jobs Act came along.
Right, dropping the corporate rate from 35% down to 21%.
That was the real accelerant.
Of course, because the biggest knock on a C Corp has always been double taxation. But if you have the 100% QSBS exclusion, you just eliminate that second layer of tax on the shareholder's exit, Suddenly, the C Corp looks way better than an LLC or an S Corp.
Precisely. And now, I mean, if you look at some proposed legislation, the capital gains rate could potentially go above 40%, maybe even 43.4% with the net investment income tax.
So a 100% QSBS exclusion in that world means you're saving almost half the total gain in federal taxes.
Which is exactly why compliance is so heavily scrutinized. The stakes are just too high.
But you mentioned earlier that the official IRS guidance is still kind of playing catch-up, despite all this money at stake.
It is. The IRS hasn't issued, robust, comprehensive regulations, especially for complex areas like an LLC converting to a C Corp or how the active business test applies to, say, a venture fund. Most of the guidance we have is reactive. It's focused on preventing abuse, especially around stock redemptions.
There's a lot of gray area.
A ton of it,
Right.
Which means any founder or investor has to be ready to defend their position.
Okay, let's pivot to the requirements, the really rigorous ones that investors have to clear. It starts with two big hurdles for the company itself.
Right. First, it must be a domestic C corporation for, and this is key, substantially all of the holding period. Second, you have to acquire the stock at its original issuance.
Meaning you can't buy it from another investor on a secondary market.
Correct. You have to get it directly from the company in exchange for cash, property, or as compensation for your services.
And then there's the nature of the business itself. That's the next big minefield.
Yeah, there's a strict list of excluded industries. It's mostly service businesses. Health, law, accounting, consulting, athletics, financial services, brokerage, or running a hotel or restaurant.
That seems pretty straightforward on the surface, but what about these really R&D heavy companies? Like, say, a biotech or deep tech company that spends 5 years in a lab with clinical trials before they ever see $1 of revenue. How does that fit the active business test?
This is a huge area for audits, a really massive one. The IRS definition of an active business can be interpreted very narrowly. An auditor could argue that years of pure research without any commercial sales looks more like a passive investment activity.
So what's the defense?
Meticulous documentation. You need detailed proof of employee activity, research milestones, clinical trial progress, operational expenses, anything to show you were actively operating a qualified business, not just holding some passive assets.
Let's drill down into the gross assets test and the basis complexity that comes with it. This is where even really sophisticated people can make mistakes. The company can't exceed 75 million post OBBA or 50 million currently in gross assets right after you get your stock. How is that calculated?
It's a very nuanced calculation. Generally, it's cash plus the adjusted basis of other property. But here's the crucial part, the thing that trips people up.
Right.
For property that's contributed to the corporation for stock, the basis used for this test is its fair market value. It's FMV at that moment. It's not the carryover tax basis. That
is a huge tripwire. So if a founder contributes, a piece of IP with a tax basis of 0, but it's worth $20 million.
That IP just pushed the company $20 million closer to that $50 or $75 million limit instantly.
And it's designed to prevent companies from qualifying just because their assets have a low tax basis.
Exactly. Now, connect that to the 10x exclusion cap. For calculating that cap, the basis you use is also the FMV of what you contributed for the stock, not the lower carryover basis.
So if I put in $2 million in cash, my exclusion cap is $20 million. Unless the 15 million flat cap is bigger.
Right.
But what if I contribute more money later? This is that infamous planning trap, right?
This is the most common self-inflicted wound. If you, as a shareholder, make a later capital contribution for your existing stock without getting new shares, that money still counts toward the company's gross asset limit.
Potentially disqualifying future investors.
Right. But, and here's the pain, that contribution does not increase your personal basis for calculating your 10x exclusion cap. It's all pain, no gain.
So the takeaway for everyone listening is always structure any new money as a purchase of newly issued stock, even a tiny amount, to protect that 10x basis calculation.
Absolutely. You have to ensure the basis benefit follows the capital.
Let's talk about the cold reality of claiming this. A big exclusion claim, over $8 million, it's like a beacon for the IRS. It just shoots your audit risk way up. What are these audits actually like?
They are methodical. And they are relentless. The auditors are highly specialized in Section 1202. They don't just ask for a summary. They want meticulous documentation.
Like what?
Original stock certificates, board minutes detailing the capital raise, and often quarterly financial statements for the entire 5 to 7 year holding period.
Quarterly financials, years later. That sounds Incredibly difficult to reconstruct.
It is. I heard about one audit where the IRS spent 3 full weeks just reviewing every quarterly P&L and payroll record. They were verifying employee counts, making sure no prohibited service revenue went over the threshold.
It's an exercise in proving you were qualified every single step of the way.
Every step. These audits can take 5 to 9 months. And the thing that consistently separates success from failure is having that documentation organized contemporaneously. You gather the proof when it happens, not trying to find an old board resolution from 2018 5 years down the road.
That explains the rise of these specialized AI services that organize this data and create preemptive memos. The risk of losing a 43% tax saving over a lost piece of paper is just too high.
It's too high.
Okay, let's move to advanced strategy. Once you've cleared all the compliance hurdles, there are ways to stretch the benefit even further. The first is managing timing with a deferral, the Section 145 rollover.
Section 145 is crucial. Let's say you sell QSBS you've held for more than 6 months, but not the full 5 years. Or maybe your game is just bigger than your $15 million cap.
Okay.
You can elect to defer that taxable gain if you reinvest the proceeds into new QSBS within 60 days.
So it's kind of like a 1031 exchange for real estate. You get to kick the can down the road.
That is a great analogy. It's a deferral. It's especially useful for partners in VC or PE funds where the fund might exit early, say at year 3. The limited partner can use 1045 to defer that gain and buy themselves more time to meet the full 5-year hold with the new stock.
And the second strategy, one high net worth investors use, is stacking exclusions. How do you multiply that $15 million cap?
Stacking is all about strategically gifting QSBS. If you have a gain that's way over $15 million, you can gift qualifying stock to non-grantor trusts or to family members. The key is that the gifted stock keeps its original QSBS status and your holding period.
So each trust or person gets their own separate exclusion.
If it's structured properly, yes. Each one can claim their own separate $15 million exclusion.
But the structuring, you mentioned it has to be incredibly precise.
Yeah.
The risk of it being deemed a grantor trust.
The risk is absolute. The IRS rules around grantor trusts, where the gains are all attributed back to you, the donor, are super complex. If they argue it's a grantor trust, the whole stacking strategy just collapses. You're looking at huge tax liabilities, penalties. You have to use specialized counsel for this.
And finally, the reality check. State taxes. All this amazing federal planning can be undone by where you live.
Absolutely. A lot of big states, like New York, conform to the federal exclusion. But others, and these are big ones like California, New Jersey, Pennsylvania, they do not.
So a taxpayer in California could exclude $15 million federally.
And still owe California state income tax on the entire gain. It makes state domicile planning a really critical conversation before any big liquidity event.
We've covered the upside, the big expansion under OBBA, the technical tightrope. Now we get to the one thing you have to keep front of mind. The one question.
What contemporaneous evidence created today proves the company's gross assets and active business status the moment you acquired the stock?
Because the most common audit areas are proving the asset test and the active business requirement at issuance. You have to collect the documentation now, not try to reconstruct it years later.
When memories are vague and documents are lost.
So to recap our deep dive, the OBBA has massively increased the incentives. The holding period is down to 3 years for a phased exclusion, the asset limit is up to $75 million, and the per issuer cap is up to $15 million.
The benefits are truly transformative, but it requires strategic choice. You have to be a C Corp. It requires continuous attention to that $75 million asset test and the active business rules, and meticulous proactive documentation. The game has changed, but the diligence has only gotten more intense.
All right, our final provocative thought for you to chew on. Given that the OBBA has raised the gross asset limit to $75 million, should every single Series B or later stage growth company, which historically avoided being a C Corp, should they start aggressively exploring converting today, even with all the IRS ambiguity, just to capture that massive $15 million per shareholder benefit?
It forces a whole new set of strategic choices, that's for sure.
Remember, this discussion is for educational purposes only. It should never be seen as tax or legal advice. Your own situation requires a consultation with a qualified professional tax advisor. Thank you for joining us for this deep dive.
We hope this empowers you to ask the right questions of your own advisors.
Until next time.